Hi, I'm Chris Wright, President of Wright Wealth Management Group. Over the last few months, I've received several questions concerning required minimum distributions on IRA accounts and other qualified investment plans as an individual reaches that magic age of 70 and a half. One of the major double whammies in regards to IRA accounts happened in 2008 when those investors that had IRAs who were over the age of 70 and a half had a required minimum distribution that they had to take. Let me give you an example. Let's say on December 31st of 2007, an investor had an IRA balance of $500,000. Well, as most investors experienced in 2008, was a 40% loss to their portfolio. That was kind of consistent as you look back to 2008 and what happened in the stock market. The S&P 500 index was down roughly 40%. So let's take an example of that investor who may have lost this 40%, and then in November of 2008 they needed to take a required minimum distribution based upon their December 31st, 2007 balance. Well, if that investor lost 40% between the months of January to November, that 40% loss was a $200,000 reduction in their balance. So their balance went from $500,000 December 31st of 2007, and then in November of 2008, their balance was somewhere around $300,000. Well, because of that major decrease, the double whammy of IRA investing incurred to some investors because the required minimum distribution, which roughly starts out about 4% at age 70 and a half, had to be taken out of the $300,000 remaining balance, even though that 4% distribution was calculated on the December 31st, 2007's balance of $500,000. So even though the investor had to take a 4% distribution out of their IRA based on the December 31st, 2007 balance of $500,000, which was roughly $20,000, when that investor decided to take the withdrawal in November of 2008, that $20,000 withdrawal was in actuality the equivalent of withdrawing roughly 7% out of the investor's account, because required minimum distribution balances are always based upon the previous year's December 31st value. Another question that often comes up concerning required minimum distributions are for those investors that have Roth IRA accounts or Roth conversion accounts. The question that they often have is, do I have to take a required minimum distribution off of my Roth IRA account or from my Roth conversion account? The answer is no. Currently, there is no required minimum distribution that is needed in regards to Roth and Roth conversion accounts. Therefore, it may make sense for some investors to do partial conversions over time to help not only reduce the amount of tax they pay in the future, but also to have an account that does not have a required minimum distribution clause built into it. In my mind, as an independent financial advisor, I feel it's very important in how investors actually invest their IRA dollars because of the required minimum distribution that the government is going to make us take out each year. We really want to have an investment mechanism or an investment strategy within our IRAs that helps to protect the balances within our IRA accounts from suffering major market losses. The reason why is this idea or this concept that the required minimum distribution is based upon the previous year's December 31st value. If we have a passive investment management portfolio that is overseeing our IRA accounts and we lose a lot of money in the stock market during a particular year of time, we still have to take a required minimum distribution based upon the previous year's value. That can add insult to injury in my mind because of the passive management losses that occurred in that portfolio. We still had to take a percentage out of our account based on a much higher value. Having a tactical management process overseeing our IRA investment accounts, to me as an independent, makes much more sense than a passive management process. The reason why is because the IRS requires us to use our December 31st prior year's balance as the balance that the distribution is based upon. Therefore, it's very important to have our portfolio concerning our IRA portfolio be invested very conservatively. One of the ways that we do that at Wright Wealth Management is to use tactical investment management strategies that oversee the volatility and the ups and downs of the markets from day to day. Therefore, we have, in my mind, a better chance to maintain level balances and withdrawals throughout the distribution phase of our life. As investors, we always have to remember that a required minimum distribution is going to be reportable on our tax return as ordinary income. We always have to remember with IRA investments that we truly have a partner in those plans. Even though that account is an IRA, which stands for Individual Retirement Account, Uncle Sam or the government is a partner in that account. We've never been taxed on those dollars previously, and as we start taking distribution, Uncle Sam or the government is going to be a partner based upon the current tax bracket we're in, and therefore we always have to remember we're most likely going to be paying taxes on those distributions. That's another reason why a lot of investors look to the Roth conversion strategy over time, with the ability to convert $1 or up to the entire account value of someone's IRA to a Roth conversion account. That puts the investor in control on how much tax they're willing to pay over time. And if they're able to do some of those conversions prior to the age of 70.5, the required minimum distributions can be reduced because the balances of the IRA accounts will also be reduced as we're doing Roth conversions. Thank you for joining me as we've discussed required minimum distributions and all the potential strategies or pitfalls that have to be considered for those investors that have IRA investments. I'm Chris Wright, President of Wright Wealth Management, and thanks for taking part of your day to listen to our program.